What if I told you you could control real estate without a bank, without amazing credit, without 20% down? I'm Anton Stetner, and we've done thousands of real estate deals here in the Seattle Metro. And we're going to talk about 20 creative financing strategies that you can use today that is being used by all the pros so that you can build wealth faster in today's market. So hit that subscribe button if you're new to the channel, and let's go through the list. Number one on the list is seller financing. You do not get what you don't ask for. You simply have to start asking more sellers if they are willing to be the bank and make all of that extra interest. You are able to negotiate flexible terms. You're able to negotiate different timelines. You're able to negotiate possibly lower interest rates. You can structure your payments uniquely. What this does is you can create win-win situations where it allows the seller to make more money and allows you to get the cash flow you need or the payment terms that you need in order to make the deal work. Number two is what's called the subject to. You take over the loan. The loan stays in the seller's name, but the title is in your name. The pros of this is it's a low upfront cost. Generally speaking, you're going to end up like maybe paying to get the loan current or title, escrow, excise tax, things like that to get the property into your name. Quite often, you're able to find properties that still have those 3% and 4% interest rates, so you get an interest rate arbitrage based on today's rates. The cons of this is you have to understand the risk. The lender has the ability to call the note due, so you should be able to refinance that or sell that before they call them due. Don't be the bad guy who damages the other person's credit. Always be the good guy and have a backup plan. So imagine being able to purchase a $700,000 home, even though your credit sucks, by simply grabbing the other person's mortgage. Number three is the lease option. The lease option will give you control of the property and allow you to capture the upside potential. You're going to get a specific rent rate, and then you get an option agreement against the property, which defines the price you're going to pay for it, the timeline in which you can do that, and this gives you specific and exclusive control of that property. Your goal then is to turn around, lease the property to someone else, create a little bit of cash flow between the rental rate and the lease option amount, and then sell it in 1 to 3 years above your option price. So let me give you an example so this thing strikes home. You get a lease option for $2,500 to exercise price at like 600 grand. You turn around and lease the property for $2,750, and then you sell it to someone else 2 years later for 700 grand. What would happen is you'd make $250 a month in cash flow and $100,000 when it closes. Think of the lease option as a vehicle to control real estate without having the actual ownership of it, but it is an exclusive right to do so, which allows you to capture all of the upside. Number four is a wraparound mortgage. You put a mortgage around the seller's existing mortgage. Let's say they have one for 300 grand. You give them one for 400 grand, and the property is worth 500 grand repaired, and you're paying them, and then they are paying the bank. We always like to take control and pay the bank for them, but what this does is it creates a new mortgage that encompasses their existing mortgage, where you essentially have two payments going on inside of it. Your goal is then to go rent the property, get a little bit of cash flow, and then sell it in 1 to 5 years and take the upside on that property. This allows you to basically become the bank without setting up all of the regulations and jumping through all the hoops and hitting the credit and income requirements to obtain a property. Number five is a contract for deed. A contract for deed is very simple. You're making installment payments, and when the installment payments are done, you can take the property. This works for rural properties. This works for properties that have title issues. This works for land development pieces. This is a moderate risk one, so make sure you do your due diligence because you don't have full ownership until you actually pay it off. But what you want to do is you want to create an upside potential so that when you do pay it off, you can then turn around and immediately sell it to capture that upside potential. And number six is just an option to purchase. We kind of talked about this in the lease option, but the option to purchase gives you the exclusive right to buy a property at a specific price during a specific time period. Your goal with an option to purchase is to create a vehicle that creates control of a property while you go create some upside potential. We like to use this in land development projects where we get it under contract with an option at today's price. And then generally speaking, we have between 2 to 5 years to exercise exercise on that option. Then we turn around and get the property rezoned, get the subdivision approved, get the lot statuses put in place, get the binding site plan, whatever it is we're going to do. Now we've done the value add, and then we can turn around and sell the option and not even close on the property, or we can close on the property and then turn around and immediately sell it at the inflated value, because as the developer, we just did all of the paper development, aka the entitlement, and massively lifted the value. Number 7, private money. You can raise capital from individuals and not banks. This is one of our favorite things. We get private money from people all the time to do our new construction projects, to do our flips, to do our land development projects. The stronger your track record becomes over time, the more examples that you can show people, the better terms you will get in the private money space. We get private money, generally speaking, below hard money costs. So we like it even more. Plus, we can get up to 100% financing and sometimes even more. This is great for flips, for burrs, for land development, just like we talked about. And understand that dear Aunt Tilly's cash that's sitting in the bank doing nothing could be the funding for your next deal. As we go through all of these items, there's going to be one that we're going to miss that you love to do. Drop that into the comments and hit that subscribe button for more videos like this. Now let's continue with our list. Number 8 is hard money. Hard money is one of those quintessential things where you're going to basically put anywhere between 10 to 25% down. You're going to be paying anywhere between 8 to 12% interest. You're going to pay around 2 points in origination fees, and it's going to be a 6 to a 12-month loan. But they don't ask a lot of questions. It's generally not based on your credit. It's generally just based on the property. So if you've got a good deal and you have a relationship with a hard money lender, you can sit there and spin cash. A lot of people say, but Anton, rates are so high. Then go find better deals. You need to be able to find a deal where you can afford to pay the hard money lender 10 or 12%, and you need to be able to do the deal fast enough to make a good enough return that the hard money doesn't matter. If you can't do it fast enough and you don't have a high enough return, don't use hard money. That's the risk. It's really expensive debt. So think about it like this. If you're at 12% and you have a $500,000 hard money out, that means it's $5,000 a month that it is costing you every month. You're wasting time and burning money. So hard money is about getting fast, getting aggressive, and getting things done because you are burning money so quickly, but it is a great tool. Number 9 is for those of you that have shitty credit. You can actually just go get a credit partner. Find someone who's got that 800 credit score, who has a long credit history. You're going to bring them in on the deal, and they're going to sign or co-sign for the deal or guarantee the deal, and then you're going to pay them a return for just being the credit partner. This can be a win-win for both parties. You now start to establish your credit, you establish your track record, and they make money for simply signing on the deal. So you're going to operate the deal, they're going to sign for it, and they're basically like a weird version of a credit card helping you out, and both of you should win during this type of a deal. Number 10 is the self-directed IRA. We love self-directed IRAs and solo 401ks. The investor gets to decide how and where to put their money. So these fund new construction builds for us, flips, land development projects, etc. Just like seller financing, generally speaking, we're able to get very good rates on this. The people who fund us with their retirement accounts know that we have a proven track record of paying everyone back and delivering on time. It becomes an awesome win-win situation. And with the stock market being so topsy-turvy, with the economy being a little bit messy right now, and all of this political pressure that's essentially happening in the background, more and more people want control of their own investments directly. This allows them to keep growing their investments tax deferred. What's really interesting, if you look at it over a long period of time, this is why I also invest in my IRA account, tax deferred growth is absolutely amazing, and I recommend you have a Roth self-directed. They can be the lender or they can JV. Most of the time they are the lender for us. So think of this as IRA equals bank from a private individual, and you're creating a win-win for both of you. Number 11 is the seller second. So what happens is, let's just say you have a $600,000 piece of property, you get $300,000 from the bank, you get $200,000 from the seller. But what happens is, because that is a blended rate, we may be able to get a lower rate overall. And also because the bank in first position only has 50% of the debt, we may be able to get cheaper debt there. So one of the ways to look at this is, if debt is at 7%, but I could get bank debt at 5 on 50% of it, and I could could get seller debt at 5 on the remaining, all of a sudden I've now got a blended rate of 5%. Or if I've got the seller at like maybe even 3%, then my blended rate is probably somewhere in the 4s. So think of stacking debt like stacking Legos. It's all about just figuring out how to make it work and how to make the numbers work. It's absolutely amazing. Number 12 is called cross-collateralization. What this is when you want to get more money from the bank and the deal doesn't quite work, you need to offer up something else as collateral. I personally have done this against duplexes and pieces of land. And so what happens is you're getting a construction loan or a land development loan, or you're doing a flip, but there's not quite enough cash in the deal. You say, hey, to sweeten the deal, I'd like you to cross-collateralize or secure this deed of trust against another property I own, sometimes in second position, sometimes in first position. What they're using is they're using the equity in that other property to allow you to qualify for more, and you're going to then need less cash. So even though you think your equity may be locked up, using cross-collateralization may be the vehicle to leverage it. Number 13 is the lease arbitrage model. This idea is when you go get a lease for a property that allows you to release it. So think of like Airbnb. You're leasing it for $3,000 a month on a monthly lease. Then you turn around and lease it out on a daily lease, just like to Airbnb. Then your cash flow will dramatically increase. Another way to do this, take that same $3,000 lease and now rent it room by room. This is the example of using lease arbitrage. You control the property, you control the cash flow, very low risk, possible high cash flow situations. And so why own one property when using this system, you could possibly go control 10 at a time? Think about that. If I'm only making $500 a property, but I could use my cash to spread it out and use this lease arbitrage model, and all of a sudden I now have 10 of them, I'm making $5,000 versus 500. Which sounds better to you? Number 14 is what we call the equity partnership. I bring in the deal, my homies bring in the money. We put it together and we figure out some type of a split that works, that satisfies them and makes them happy. It could be a 50-50 split. It could be a 70-30. It could be a 60-40. It could be 60% in their favor, 40% in ours, or vice versa. It will all depend on the deal. But having individuals in your life that have capital, that know, like, love, and trust you, who are willing to put the money into the deal beside you for a return is a great example of an equity partner. Number 15 is what's called a performance-based payoff. This is where the property is essentially under contract. You don't own it yet, but when it hits a certain threshold, the seller gets paid out and you get paid out. So an example would be you bought a multifamily that you're going to value add. It allows you to value add before you own it. You start doing the value add, and then once it hits a certain cap rate or a certain level of cash flow, you are required to pay the seller out. And that seller could be paid out via a refinance or a sale. So this is one of those cash light, seller aligned, massively flexible things when you can find it for the right property. The seller gets paid when it hits the terms of the deal. This is massively win-win, but try going and negotiating this with a regular bank. It's never going to happen. Number 16 is what's called the master lease agreement. And we kind of referred to this during the lease arbitrage in the Airbnb example. But a master lease agreement allows full control of the property. And then the master lease agreement then dictates that you have the right to sublease a property. Master leases, though, are much more common in commercial spaces. So you would take a master lease for a 20,000 foot warehouse. Then you would chop the warehouse up to 4 5,000 foot spaces and sublease it to someone else. Your master lease says that you've got to pay 15 grand a month, and you turn around and get each spot leased for 65 $500 a month. There is an initial risk period when the property is not leased out while you're working through this, but once you have it moving, a master lease agreement can literally puke cash. We also like to use the master lease agreement with an option agreement because then I have control and then I have the right to purchase at some point in the future. So the master lease is no debt, you're taking control, you're agreeing to a monthly payment, and then you're taking in the difference in the upside. What a phenomenal vehicle. Number 17 is what's called a convertible note. You raise capital as debt that has the right to convert to equity in the future. This is a deferred equity dilution. It creates upside for lenders if the project is going well, and they can then decide, hey, do I just want to get paid interest, or would I like to be an active part of this specific property? If the deal crushes, they always convert and want to go along for the ride. If the deal tanks, then they just get their interest. This can be an awesome vehicle to generate a lot of capital for bigger deals. Number 18 is what's called the deferred down payment. So you close now, but you pay your down payment over time. So there's going to be deals that you're going to put together and they're going to need 25% down, but you don't have the whole 25 today. So you're going to just structure larger monthly payments or a balloon payment to defer part of that down payment over time. This keeps more cash in your pocket. So this works for very cash sensitive deals, land development, value add, while still securing the deal and allowing you to capitalize on the upside potential. Another amazing vehicle. Number 19 is to grab a 1031 equity roll-in partner. Holy cow, what does that mean? It means they just did a 1031 and they've got capital to throw into a project. This allows them to defer their gains and for you to scale up your capital stack real quick in order to be buying more property. This is a very advanced one, and this is not for the faint of heart, but this is extremely powerful for big deals. How we have used this quite often is the 1031 equity partner is purchasing a piece of land. They are then putting that piece of land into the partnership as their percentage. And then we bring in the sweat equity, the knowledge, and also some capital too, to take that property to the next level. So they're going to roll their equity, not pay a ton of taxes, and give you jet fuel for your next real estate project. Let's freaking go. Number 20 is the performance joint venture, or what we call sweat equity. What you're going to do is you're going to put together a deal where you personally are going to trade your time, your skills, your knowledge, your management, whatever it may be. This is great for wholesalers, for project managers, for land developers, for flippers. You put together the deal, they bring the cash, and you take a chunk of the sweat equity. That could be anywhere between as low as 20% to as high as 80%, depending on the deal and your track record. This is another one we absolutely love. Simply turn your hustle in real estate and your deal flow into cash using this particular strategy. There you have it. These are the 20 creative financing strategies used by every investor to scale in today's market. So bookmark this, save it, hit that subscribe button, send it to a friend who needs to understand all of these. And what I want you to do is I want you to pick one strategy. Go start applying it right now. And then let us know in the comments how you did it and what you are having success with in today's market.